Well, good afternoon and welcome to HIROC's weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We do invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of the opportunities that avail themselves to us. I'm Scott Tomlinson. My partner and colleague Paul Tepsich, the founder of HIROC, is also with us, as is our financial planner and wealth forecast specialist, Bianca Tomlinson. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, as you all well know by now, our overriding theme for 2016 is that financial markets will remain volatile. It was a volatile couple of weeks leading up to the U.S. presidential election, but the election results caught many by surprise, and now the world is faced with even more uncertainty. We think that if the Trump administration follows through with tax reductions and infrastructure spending plans that he did campaign for, that U.S. debt levels will jump, and it will be positive for GDP growth and inflation. But that spending will not likely kick in till about mid-2017. So until then, uncertainty could still be a problem for the economy. Forecasters are raising their inflationary expectations, and central banks will have to weigh these changes into their policy-making decisions. Chances of a Fed rate hike in December are higher now at about 85%. The new U.S. government may reshape the global political spectrum, but we will have to wait and see how that unfolds. In the meantime, the populist movement will grow, putting pressure on the global trade picture. Bond markets are back in their leadership role as a close to 0.5% increase in 10-year yields in the U.S. anticipates both new supply to cover deficit spending and higher inflation outlooks. Despite better than expected earnings for the third quarter and positive year-over-year growth expected for the fourth quarter, equity market prices still do not truly reflect the underlying fundamentals. 2016 earnings are expected to come in close to flat on the year with no growth, yet S&P 500 prices are higher by close to 6% so far this year. Growth may return to the economy in 2017 and 2018, and inflation should follow suit. But until then, benchmark returns will remain well below average. Year to date, the 60-40 balanced portfolio model is still it has been performing under 3%. Now, looking forward, however, if all falls into place in the new regime, there may be room to add risk to a portfolio as growth starts to return, but we will be picky and very choosy, picking our spots very carefully. Well, let's look at what has been driving markets over the last week. The early response to the election results pushed stock market prices lower by almost 5%, but before the day was out, they were back up close to 6% from those lows. Now that that is volatility. But although stock prices have stayed at or near those levels, the volatility is now in the bond market. Canadian high-yield bonds have been a very good place to be diversified into because of their zero correlation to interest rates. So while government bond yields have been wildly volatile, the Canadian high-yield space has not been, and is a good asset class for diversification. At HIROC, we are specialists in this asset class, so our clients can be assured that they do have some exposure to that. Now, in contrast, U.S. high yield has been significantly more volatile, as we regularly state, And I offered up in my blog last Friday, Canadian high yield offers better risk-adjusted returns. And there will be more fear with higher levels of volatility, and we predict that that fear will continue. And again, I mention this each week, but I think it's important to remind you all how broad and diverse our global benchmark equity index is. We compare the performance of our global equity model to the performance of this index, which covers close to 2,500 companies domiciled in 23 developed countries and 23 developing countries, and covers 10 economic sectors. We want to have a global focus so as not to be susceptible to what is called the home country bias, where investors are under-diversified and take on greater amounts of risk by being too exposed to assets of the country that they live in. It is also important to remember that many of the companies in our benchmark index have a global perspective, so we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. Well, our benchmark equity index is unchanged since we last spoke. Emerging markets are lower by about 7% as a result of fallout from the election. The Japanese and German markets were up by more than 2%. Year to date, the benchmark total return is 484. 1 year, just a little over 5%, 3 year, 285, and the 5 year at just a little under 8.5%. As I said, emerging markets have dropped significantly in the last week over the fear of trade protectionist policies from the new U.S. government. Our clients continue to be underweight exposure to this asset class and have been since May of 2015. But we wait for value opportunities to develop. The bond prices are significantly lower. Our benchmark XBB is down by over 1.5% since our last webinar, and the year-to-date total return is just a little over 1.5%. The 3-year return about 338, the 3-year return about 431, and the 5-year return just a little under 3.25. So bond markets having felt a good chunk of the impact from the U.S. election. Well, stocks and bonds are once again negatively correlated, but bond weakness has more than offset stock market strength, definitely putting pressure on balanced portfolios. And if you combine the equity and bond indices into a balanced scenario and allow for fees and MER costs, the total benchmark return for a 60% equity and 40% bond index combination year to date is 2.5%. 1 year is about 3.25%. 3 years about 2.25%, 5 years about 5.25%, and a supposedly less risky and more growth-oriented or less growth-oriented 40% equity, 60% fixed income is only up 1.88% year to date, 2.9% over 1 year, 2.58 over 3 years, and 4.17% over the 5-year period. Clearly, the traditionally fully invested balanced 60-40 and 40-60 portfolios have had the stuffing knocked out of them over the course of the last week by the bond market move and the emerging stock market volatility since the U.S. election. Now, that is a greater amount of volatility than we or our clients would like to see in our portfolios. So when we look at the portfolio of a High Rock client who started with us in January and has a 60-40 balanced portfolio, which includes an underweight exposure to equities, recently adjusted exposure to fixed income, and also more exposure to non-correlated assets in our tactical model, the total return this year to date after fees and costs is a little over 6.5%. Last week it was about 6.75%, so it's down about 0.25% over the course of the last week. Well, the combined fully invested benchmark total, as I mentioned before, after allowing for fees and costs over the same time period, is about 2.5%, which is lower by about 2% over the course of the last week. So our defensive strategy with lower exposure to the equity market than the benchmark and greater exposure to non-correlated assets through our tactical model has had significantly better returns. For our client, lower volatility better risk-adjusted returns and a better total return. Now, after fees and costs, the one-year performance of a 60/40 HIROC client is at 6.18%, a return compared to the combined benchmark at 3.25%. Now, the longer-term 4+ year annualized total return since inception of 7.77 versus the benchmark of a little over 4.5 over that same time period. Now, I must also remind all of our listeners that historical returns are in no way a guarantee of future returns, although at HIROC we do work very hard to try to get the best possible risk-adjusted returns for our clients and ourselves at all times. Well, what else on the week? Oil is a little higher since our last webinar. There's hope among OPEC nations that a deal might be made at their November 30th meeting for an output cut. Failure to do so could push prices back down towards that $40 level. And the Bloomberg Commodity Index was lower over the course of the last week. Well, the U.S. represents more than 20% of the global economy, and with over 50% of the companies in our benchmark index domiciled in the U.S., we do keep a close eye on what is happening there. Well, the U.S. presidential election results have changed the economic and investing landscape, and we are all putting in extra hours of research to handle all of the what-if scenarios. Now, in a nutshell, economists surveyed by the Wall Street Journal expect higher GDP growth beginning in 2017, which will also push up inflation. And as we've discussed already, bond markets are already building in an additional 0.5%, but clearly by 2018, they're anticipating the 10-year yield to move higher towards approximately 3%. Well, with additional spending, tax cuts offering fiscal economic stimulus, recession may slip to the back of forecasters' priorities. However, there is going to be a gap between now, when it all starts, and when it all starts to kick in. All that economic aid starts to kick in and add growth. And, of course, in the interim, interest rates are on the rise. The short term could hold some surprises. Well, on November 2nd, the Federal Open Market Committee decided to wait for further evidence of economic strength before raising rates. The odds of a December increase of 0.25% stand now at about 85% chance. And elsewhere in the global economy, other central banks have been sitting on their hands waiting to see how financial markets and economies evolve. December will be chock full of interest rate decisions. With the Bank of Canada on December 7th, the European Central Bank on December 8th, the U.S. Federal Reserve on December 14th, the Bank of England on December 15th, and then the Bank of Japan on December the 20th. Well, where is all this going to take us? Well, bond markets do lead normally and have regained that leadership once again. As I mentioned earlier, the U.S. bond market has built in a scenario which entails more bond issuance in the future and the prospects for higher inflation, and this has pushed yields higher and steepened the yield curve all at the same time. The Canadian yield curve followed the U.S., which will certainly have ramifications for borrowers and mortgage renewals. Given the amount of household debt outstanding, Canadian households could find their debt servicing costs rising. This may also impact the housing market as those with borderline affordability begin to struggle. Today, the Royal Bank raised mortgage rates, and certainly other banks are going to be hot on their heels. Well, the UK curve also steepened, but rates have not risen quite as much as they have in the US and in Canada. And the same for the German Euro yield curve. Yields are now below zero only out to 8 years. They have moved in from being below zero out beyond 10 years over the last few months. And in Japan, yields are at zero below 10 years. As for equity market value for the third quarter, with 91% of companies reporting, 71% have beat estimates, and actual plus expected earnings are now at a plus 2.9%. Now this, as I mentioned earlier, is the first positive year-over-year earnings growth since the first quarter of 2015. Now, why are earnings important? Well, because they are the fundamental reason for buying stocks. When investors buy stocks, they buy a stream of future earnings which go to pay dividends or are reinvested in the company. The price-to-earnings ratio represents one metric to measure stock prices relative to earnings. The 10-year average price-to-earnings ratio is 14.3 times. The 12-month forward price-to-earnings ratio, which incorporates analyst forecasts for earnings 12 months into the future, is currently at a relatively expensive 16.6 times. So what does it all mean? Well, for well over a year now, we have taken a cautious and defensive posture to investing because of our concerns of heightened levels of volatility. That does not mean that we are not investing, but we are utilizing our experience and skill to ensure that our and our client portfolios are invested to achieve the best possible risk-adjusted returns. It is clear that we have been able to not only capture growth, but keep it in times of higher volatility. Part of the success of our year-to-date returns comes from what we have been able to do and achieve in our tactical model. We have been active through a combination of intrinsic value trades, strategic trades in energy stocks and high-yield bonds, and some event-driven trading that came to fruition in early October. Now, this is unique. Signature model has added considerable non-correlated value to our client portfolios over the course of the year. And if Paul wants to add anything enlightening, I'm going to ask him to jump in right now.
I would love to add something enlightening, Scott, but I'm sure I don't have a whole bunch that is enlightening. But I will add what I can. You mentioned a couple of our event-driven trades that came through in early October. We did fully monetize our direct cash stock position at $19. So I think our average cost in that was like 13 and change, low 13s maybe. We clipped out some dividends, but the chance of hanging on for further dividends was negligible at best, and the bulk of the money was made. So we monetized that position, sold it right out. We still have our other event-driven trade, which we haven't altered the position on in several weeks now, but we do own the stock, a convertible bond, and a high-yield bond, all of which I believe had a little bit more upside, and that timeline on that trade will be into mid-January is when the shareholder vote takes place. So I think there's still a little bit upside, but we have also taken we've had a pretty good run in that one as well. We have a few high-yield bonds that I believe still have some upside, and that is largely where our energy exposure is. Again, those high-yield bonds are in the tactical portion, not in the fixed income portion. We have a couple individual stocks. We did lighten up on a few a month ago, and looking at a couple others to add right now. I've been doing some work on a couple of specific names. And away from that, there haven't been a huge change in the overall portfolios. I would add, Scott, as well, that we did do a very small amount of lightening up in some long-dated fixed income paper and bought some floating rate paper just to protect ourselves in case rates continue to go up, which they obviously have done over the past week. But we think these floating rate notes that we're buying are floating rate paper is trading intrinsically rather cheap. It's been hammered over the past year and a half, and we think it's time to step in. So we've done a lot of work on that, and we started buying. That's it.
Tremendous. Well, that's great work, Paul. Thanks so much. And I think hats off to all the hard research that you do behind the scenes to put our portfolios and our clients' portfolios in a better light. And it certainly helps us be able to add value while at the same time continue to focus on reducing the exposure to some of the more volatile aspects of the market, even for some of the balanced portfolios that we've been comparing our own portfolios to against the benchmarks. You can see where our portfolios are significantly less volatile even though those other balanced portfolios have been through some pretty significant volatility over the last week. So great work. Thanks so much, and thanks for bringing us up to date. Well, that's it for today's discussion. If anybody listening live would like to ask questions, please, we're here for you to do so. Okay, no live questions this week, but if you are listening to the recorded version and you do have questions, please feel free to email them to us. We certainly appreciate all the feedback that we do get on these calls. It's important for us to talk about the things that you want us to talk about. As always, thank you for taking the time out of your busy schedule to tune in. Don't forget to tune back in next week. But until then, this is Scott Tomlinson signing off.